Let me ask you something that might make you uncomfortable. If you are over 70 years old right now, how much of your portfolio can you actually afford to lose? Not theoretically, not in some academic exercise. I mean really, truly afford to lose without it fundamentally changing your retirement, your lifestyle, your ability to take care of yourself and the people you love. Because here's the brutal truth that nobody wants to talk about. When you are 30 or 40 or even 50, a market crash is an inconvenience. It is a paper loss. You have time. You have decades for the market to recover, but when you are over 70, a 50% drawdown is not just a number on a screen. It could be the difference between independence and dependence, between living comfortably and running out of money, between leaving something to your children and becoming a financial burden on them. I have spent my entire career studying market crashes, not because I enjoy being pessimistic, but because I understand something that most investors never learn until it is too late. Protecting what you have is far more important than chasing what you might gain. And right now, in late 2025, heading into 2026, I am seeing warning signs everywhere. Warning signs that tell me the next major market downturn could be devastating for anyone who is not properly positioned. Today, I am going to share my ultimate wealth preservation strategy, specifically designed for investors over 70. This is not about getting rich. Those days are behind you. This is about protecting what you have spent a lifetime building. This is about making sure your money lasts longer than you do. And this is about sleeping well at night, knowing that no matter what the market does tomorrow or next year or over the next decade, you are going to be okay. Let me take you back to a moment that shaped everything I understand about risk and preservation. It was 2008. I had made one of the largest bets in financial history against the subprime mortgage market. Everyone thought I was crazy. The banks, the regulators, even some of my own investors wanted to pull their money out. They could not understand why I was betting against what seemed like an unstoppable housing market. But I had done something that almost nobody else had done. I had actually read the loan documents. I had looked at the underlying mortgages in these securities that everyone was calling safe. And what I found was terrifying loans to people with no income, no jobs, no assets, adjustable rate mortgages that would reset to payments people could never afford. An entire financial system built on a foundation of sand. When the crash came, it validated everything I had feared. Trillions of dollars in wealth evaporated, retirement accounts were cut in half. People who thought they were set for life suddenly found themselves working into their 70s and 80s because they could not afford to retire anymore. And the people who got hurt the worst were not the young investors with decades ahead of them. It was the older investors, the ones who were already retired or close to it, who had the most to lose and the least time to recover. That experience taught me that the real skill in investing is not making money. Anyone can make money in a bull market. The real skill is keeping it, preserving what you have built, recognizing danger before it arrives, and positioning yourself to survive whatever comes next. Now, before I share my specific strategy, I need you to understand something fundamental about how I think about wealth preservation. Most financial advisors will tell you to diversify across stocks and bonds and maybe some real estate. They will show you fancy charts about modern portfolio theory and efficient frontiers. And that advice might be perfectly fine for someone who is 40 years old with a long time horizon. But when you are over 70, the rules change completely. You do not have time for the market to recover from a major crash. You cannot simply wait it out. You need a different approach entirely, an approach that prioritizes safety over growth, an approach that guarantees you will never be forced to sell at the worst possible time, an approach that lets you sleep at night no matter what the headlines say tomorrow. My wealth preservation strategy for investors over 70 is built on 4 core principles. And if you follow these principles, I believe you can protect yourself from almost any market environment while still maintaining enough growth to keep pace with inflation and preserve your purchasing power. The first principle is what I call the 5-year cash buffer. This is the foundation of everything else. Before you invest a single dollar in stocks or bonds or anything else, you need to have 5 full years of living expenses set aside in completely safe liquid assets. I am talking about treasury bills, money market funds, high-yield savings accounts at FDIC-insured banks, cash or cash equivalents that you can access immediately without any risk of loss. Why 5 years? because that is roughly how long the average bear market lasts from peak to trough to full recovery. If you have 5 years of expenses set aside, you never have to sell your investments during a downturn. You can live off your cash buffer while you wait for your portfolio to recover. This is absolutely critical, because the worst thing you can do as an older investor is be forced to sell stocks after they have fallen 50%, just because you need the money to pay your bills. Let me give you a specific example. Let us say you are 72 years old and you need $80,000 per year to live on, including all your expenses, taxes, healthcare, everything. Under my strategy, you would set aside $400,000 in completely safe cash equivalents. That is 5 years times $80,000 per year. This money earns whatever the current Treasury bill rate is, maybe 4 or 5% right now. But the primary purpose is not growth. The primary purpose is safety and access. Now, I know what some of you are thinking, Michael. That is a lot of money sitting in cash, earning relatively low returns. And you are right. In a normal market environment, having that much cash might seem conservative to the point of being inefficient. But here is what you need to understand. That cash buffer is not about maximizing returns. It is about buying you something far more valuable: time. Time to let your investments recover. Time to make rational decisions instead of panicked ones. Time to sleep at night without worrying about what the market is going to do tomorrow. I have watched so many retirees make the devastating mistake of being fully invested when a crash hits. They have no cash buffer, they have no cushion. So when the market drops 40 or 50% and they still need money to live on, they are forced to sell their stocks at the worst possible time. They lock in their losses permanently, and they never recover because they sold at the bottom instead of waiting for the recovery. The 5-year cash buffer prevents this entirely. It gives you the financial freedom to wait out any storm. And that peace of mind is worth far more than whatever extra returns you might have earned by keeping that money invested. The second principle of my wealth preservation strategy is what I call defensive equity allocation. Now, even with a 5-year cash buffer, you still need some exposure to stocks. Without any equity exposure, inflation will slowly erode your purchasing power over time. $1 today will buy significantly less in 20 years, so you need some growth in your portfolio just to maintain your standard of living. But the type of equity exposure matters enormously when you are over 70. You cannot afford to own speculative stocks. You cannot afford to own high-flying growth companies that might drop 70 or 80% in a market correction. You need to own the most defensive, stable, dividend-paying companies that exist. I am talking about companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, companies that have been around for over a century. Companies that sell products people need regardless of what the economy is doing. People still brush their teeth during a recession. They still wash their clothes. They still buy basic consumer staples. These companies generate consistent cash flows year after year, and they return that cash to shareholders through dividends that have been growing for decades. Here is why this matters so much for wealth preservation during the 2008 financial crisis. The overall stock market fell about 57% from peak to trough, but many defensive dividend stocks fell much less, maybe 30 or 35%. And more importantly, they kept paying their dividends throughout the crisis. So even if the stock price dropped, you were still receiving income that you could live on without selling any shares. Compare that to owning something like a technology growth stock during a crash. Those can drop 80 or 90%. They pay no dividends, you have no income unless you sell shares. And if you need money to live on, you are forced to sell at the worst possible time, locking in massive losses. Let me give you some specific numbers to illustrate why defensive stocks matter so much. During the dot-com crash from 2000 to 2002, the NASDAQ composite fell about 80%. 80%. If you had $1 million in tech stocks, you ended up with $200,000. But defensive dividend stocks in the consumer staples sector fell maybe 20 to 30% during that same period. And they kept paying dividends the entire time during the 2008 financial crisis. The S&P 500 fell about 57%. But if you look at the best defensive dividend stocks, companies like General Mills, Hormel Foods, and Walmart, they fell much less. Some of them were actually up during parts of that crisis as investors fled to safety. and all of them kept paying and even increasing their dividends throughout. This is the power of defensive investing. You participate in the market's upside during good times. Maybe not as much as aggressive growth investors, but you participate, and during bad times, you fall much less and maintain your income stream. Over full market cycles, this approach often produces similar or even better returns than aggressive investing, with far less volatility and stress. I specifically look for companies with what I call defensive characteristics: low debt levels, consistent earnings that do not swing wildly with the economy, products that people need, not want, strong market positions that protect them from competition, long histories of paying and raising dividends. These are the companies that survive recessions and come out stronger on the other side. For investors over 70, I recommend limiting your equity exposure to no more than 30 to 40% of your portfolio after the cash buffer. And that equity exposure should be concentrated in the most defensive sectors: consumer staples, healthcare, utilities, dividend aristocrats that have raised their dividends for 25 years or more in a row. These are the companies that will protect you during the storms that are surely coming. I also want to talk about the specific type of defensive investing that has worked best for me over the years. Value investing, finding companies that are trading below their intrinsic value. Companies where the market price does not reflect the true worth of the business. This approach provides what I call a margin of safety. If you buy a company that is worth $15 for $10, even if you are partially wrong about the valuation, you still might not lose money. But if you buy a company at 50 times earnings based on optimistic projections of future growth, you have no margin of safety at all. Any disappointment will be devastating. For older investors, this margin of safety is absolutely essential. You cannot afford to be wrong. You cannot afford to own overvalued stocks that could crash at any moment. Every investment needs to be made with preservation in mind first and growth second. The third principle of my wealth preservation strategy involves treasury bonds, but not the way most people think about them. Most financial advisors will tell you to buy long-term bonds as you get older. They will say that bonds provide stability and income, and in normal times that might be reasonable advice. But we are not living in normal times. We have just experienced the worst bond market in decades. Long-term treasury bonds lost almost 40% in 2022 alone. That is supposed to be the safe part of your portfolio, the stability, and it lost nearly as much as stocks during some crashes. This happened because interest rates rose dramatically from near zero to over 5% in a very short time. And when rates rise, bond prices fall. The longer the duration of the bond, the more it falls. For older investors, I do not recommend long-term bonds at all. Right now, the risk is simply too high. Instead, I recommend short-duration treasuries. 1 to 3 year maturities at most. Treasury bills that mature in 3 months or 6 months or a year. These provide decent income at current rates, around 4 to 5%, with minimal interest rate risk. Here is why this matters. If you own a 30-year treasury bond and interest rates rise another 2%, you could lose 25 to 30% of your principal. That is devastating for a 70-year-old who cannot afford to wait decades for their bonds to mature. But if you own a 1-year treasury bill, you lose almost nothing. You simply wait for the bill to mature, get your principal back, and reinvest at the new higher rate. For wealth preservation, short duration is everything. You want your fixed income to provide stability and income without exposing you to the interest rate risk that destroyed so many bond portfolios in 2022. I recommend keeping your fixed income allocation entirely in short duration treasuries and high-quality short-term corporate bonds. Nothing longer than 3 years, ideally much shorter than that. This approach gives you the stability you need without the risks that most people do not even realize they are taking when they buy long-term bonds. And in an environment where I believe interest rates could stay elevated or even rise further due to massive government deficits and persistent inflation, this protection is essential. The fourth and final principle of my wealth preservation strategy is what I call crisis insurance. This is the part that most investors miss entirely. They think that diversification across stocks and bonds is enough. But true wealth preservation requires having some allocation to assets that actually go up when everything else is going down. I am talking about gold, physical gold, not gold mining stocks. not gold ETFs that might have counterparty risk. Actual physical gold that you can hold in your hands. Gold has served as a store of value for thousands of years. It has survived the fall of empires, world wars, hyperinflation, and every other crisis you can imagine. And it tends to perform best precisely when other assets are performing worst. During the 2008 financial crisis, gold was one of the few assets that actually held its value while stocks and real estate were collapsing. During periods of high inflation, gold has historically preserved purchasing power when paper currencies lost value. And during times of geopolitical instability, gold has served as a safe haven when trust in financial systems breaks down. For older investors, I recommend having 5 to 10% of your portfolio in physical gold. Not because I think gold is going to make you rich. It probably will not. But because gold provides insurance against the kinds of catastrophic events that could destroy a traditional stock and bond portfolio. It is the ultimate form of wealth preservation. Let me explain what I mean by crisis insurance more specifically. There are certain scenarios that, while unlikely in any given year, would be absolutely devastating if they occurred. A major sovereign debt crisis where confidence in government bonds collapses. A currency crisis where the dollar loses significant value rapidly. A prolonged period of stagflation where both inflation and economic stagnation persist for years. A geopolitical catastrophe that disrupts global trade and financial systems. In any of these scenarios, traditional stocks and bonds could both decline significantly at the same time. Your diversification across these asset classes would not protect you because they would all be moving in the same direction. Down, but gold typically performs well in exactly these kinds of crisis scenarios. It is the one asset that exists outside the financial system. It does not depend on anyone's promise to pay. It cannot be printed or devalued by central banks. It just exists. I think of gold like I think of fire insurance on my house. I do not expect my house to burn down. I hope it never does. I would actually prefer that my fire insurance be a complete waste of money, because that means nothing bad happened. But I still pay for it every year, because if something does happen, I want to be protected. Gold is the same concept. Most years, gold will probably underperform stocks and bonds. Most years. You might look at your gold allocation and think it is dead money just sitting there. But the one year when everything else is falling apart, when the financial system is stressed, when confidence is evaporating, that is when gold will prove its worth. That is when you will be grateful you had that insurance. Now, some people argue that gold pays no dividends and has no yield. And they are right. Gold just sits there. But that is precisely the point. Gold does not depend on any company performing well. It does not depend on any government paying its debts. It does not depend on any financial system functioning properly. It is the one asset that has value independent of everything else. And when you are over 70 and wealth preservation is your primary goal, that independence is incredibly valuable. Let me put all of this together into a specific allocation that I would recommend for someone over 70. This is not personalized financial advice. Obviously, your specific situation might be different. But this framework captures the principles I have been discussing. First, calculate your annual living expenses. Everything you need to live on, including taxes, healthcare, travel, everything. Multiply that by 5, that is your cash buffer. Keep it in treasury bills, money market funds, and FDIC-insured savings accounts. This is completely off limits for investing. This is your survival money second. With the remaining portfolio after your cash buffer, allocate roughly 40% to defensive equities. This means dividend aristocrats, consumer staples, healthcare, utilities, companies that have survived every recession and kept paying dividends. Buy them when they are trading at reasonable valuations with a margin of safety third. Allocate roughly 45% to short-duration fixed income. Treasury bills and notes with maturities under 3 years, high-quality short-term corporate bonds, nothing with significant duration risk. This provides income and stability without the interest rate risk that devastated long-term bondholders recently. Fourth, allocate roughly 10 to 15% to physical gold. Keep it stored safely. This is your crisis insurance, the asset you never want to need but will be incredibly grateful to have if things fall apart. No, let me address something important. This allocation is significantly more conservative than what most financial advisors would recommend. They might say you are leaving returns on the table. They might show you backtests that suggest higher equity allocations would have performed better historically. And you know what? They might be right in terms of pure returns, but here is what they are missing. You are over 70. Your time horizon is different. Your ability to recover from losses is different. Your psychology around money is different. The pain of losing 50% of your portfolio at this stage of life is not equivalent to the joy of gaining 50%. The downside matters far more than the upside. I would much rather have someone over 70 earn 6% per year with minimal volatility and sleep well at night than earn 10% per year while suffering through stomach-churning drawdowns that might cause them to make emotional mistakes or literally affect their health from the stress. The purpose of money at this stage of life is to provide security and peace of mind, not to generate maximum returns. I want to talk about something else that is critically important for wealth preservation: the psychological aspect, because I have seen so many older investors make devastating mistakes, not because their strategy was wrong, but because they could not stick with it emotionally during difficult markets. When the market is dropping day after day, when the news is full of panic, when your portfolio is showing red numbers every time you check it, the temptation to do something, anything, is almost overwhelming. And that temptation is exactly what destroys wealth. Selling after a crash is the worst thing you can do. But it is also the most natural human response to fear. This is why the 5-year cash buffer is so important psychologically, not just financially. When you know that you have 5 years of expenses set aside, when you know that you do not need to sell anything no matter what happens, that knowledge gives you the emotional strength to ride out the storms. You can watch the market crash and think, this does not affect me right now. I have time. I can wait. I cannot overstate how powerful this psychological buffer is. I have spoken with hundreds of investors over the years. The ones who make it through tough markets with their wealth intact almost always share one characteristic. They have liquidity, they have options, they are not forced to do anything. The investors who get destroyed are the ones who are forced to act at the wrong time because they did not plan ahead, think about it this way. If you are watching the news and seeing markets plummet day after day, and you know that your next 5 years of expenses are sitting safely in treasury bills earning interest, how do you feel? You feel calm. You feel in control. You can objectively evaluate whether the crash represents a buying opportunity or a genuine economic catastrophe. You can make rational decisions because your survival is not at stake. But now imagine the opposite: your money is fully invested. You have maybe 6 months of cash, the market drops 40%. You are watching your retirement savings evaporate, and you know that in a few months you are going to have to start selling stocks just to pay your bills. How do you feel then? You feel terrified, you feel out of control. Every day the market goes down feels like a punch in the gut. And eventually the pain becomes too much and you sell at the worst possible moment just to make the pain stop. That is the difference. That is why cash buffer comes before everything else. It is not about the returns, it is about the peace of mind. That peace of mind is worth more than any return you might earn from being more aggressively invested, because the investors who panic and sell at the bottom give back years of gains in a single moment of fear. The investors who stay calm and wait for the recovery end up far ahead. Let me tell you about a friend of mine who learned this lesson the hard way. He was 68 years old in 2008, had about $2 million saved for retirement, felt pretty good about his situation. But he was fully invested in stocks, had maybe 3 months of expenses in cash. When the crash came and his portfolio dropped to under $1 million, he panicked. He could not sleep. His wife was terrified. And at the worst possible moment, with the market down over 50%, he sold everything and moved to cash. He locked in losses of over $1 million. And then he was too scared to get back in. He watched from the sidelines as the market recovered over the next several years. By the time he finally felt comfortable investing again, he had missed most of the recovery. His $2 million portfolio that should have recovered and then grown to over $3 million ended up being worth barely over $1 million even a decade later. His retirement was fundamentally different than it should have been, all because he was positioned wrong and could not handle the emotional pressure. Do not let that be you. Do not put yourself in a position where fear can make you do something you will regret for the rest of your life. I have been through multiple market crashes now, 2008, 2020, various other corrections along the way. And I can tell you that the investors who survive and even thrive during these periods are not the ones with the best stock picks or the most sophisticated strategies. They are the ones who have positioned themselves so they never have to sell. They are the ones who have the financial and psychological strength to wait out any storm. Let me talk about some specific things I am watching right now that concern me. Things that reinforce why wealth preservation is so important heading into 2026. Government debt is at unprecedented levels. The United States has over $34 trillion in debt. Interest payments alone are over $1 trillion per year and rising. This is not sustainable. At some point, something has to give. Either taxes rise dramatically, or spending gets cut dramatically, or inflation erodes the debt. Or we have some kind of fiscal crisis. None of these scenarios are good for traditional investment portfolios. The stock market is trading at historically elevated valuations, not as extreme as the dot-com bubble, but well above long-term averages. The cyclically adjusted price-to-earnings ratio, also called the Shiller PE, is around 35. The historical average is closer to 17. When markets have traded at these valuations in the past, subsequent 10-year returns have typically been disappointing. We are seeing signs of economic slowdown. Consumer spending is weakening. Credit card delinquencies are rising. The job market is cooling. The effects of higher interest rates are still working their way through the economy. A recession in 2026 or 2027 is entirely possible, perhaps even likely. Commercial real estate is in serious trouble. Office vacancy rates are at record highs. Many buildings are worth far less than the mortgages against them. This is creating stress in regional banks that hold these loans. We could see more bank failures like we saw in 2023. The work-from-home shift has fundamentally changed how companies use office space. Before the pandemic, most assumed workers would be in the office 5 days a week. Now, many companies have adopted hybrid models or gone fully remote office buildings that were valued at hundreds of millions of dollars are selling for pennies on the dollar or not selling at all. And the loans against these buildings, many of which are held by regional and community banks, are going bad at an alarming rate. I have been studying the situation closely, and the numbers are staggering. There is over $1 trillion in commercial real estate loans coming due in the next couple of years. Many of these properties cannot refinance because they are worth less than the existing loan balance. The owners will have to put in more equity, which they may not have, or default on the loans. This is going to create significant stress in the banking system. And it is not just offices. Retail properties have been struggling for years with the shift to e-commerce. Malls that were once vibrant community gathering places are now half empty or closed entirely. The anchor tenants that used to drive traffic, the big department stores, are either bankrupt or dramatically smaller than they used to be. Even multifamily residential, which was the darling of commercial real estate for years, is showing cracks. Rents are falling in many markets because too much supply was built when interest rates were low. Properties that made sense at 3% interest rates do not make sense at 7%. Values are declining, and some developers are walking away from projects entirely. All of this commercial real estate stress is going to ripple through the economy. Banks that take losses will tighten lending. Construction workers will lose jobs. Local governments that depend on property taxes will see revenue decline. It is a slow-moving crisis, but it is coming. Geopolitical risks are elevated. The situation with China and Taiwan, conflicts in the Middle East, trade tensions and tariffs, any of these could escalate in ways that shock financial markets. I am not saying any of these things will definitely happen. I am not predicting a crash tomorrow or next month. What I am saying is that the risks are real and elevated. And when you are over 70, you cannot afford to be wrong. You cannot afford to be caught unprepared when one of these risks materializes into an actual crisis. This is why I keep emphasizing preservation over growth. The potential upside of being aggressive right now does not justify the potential downside. The risk-reward ratio is not favorable for older investors. Better to earn modest returns safely than to reach for higher returns and risk losing everything. Let me also address something that I know will come up. Many people will say, "Michael, the stock market has always recovered eventually. Every crash has been followed by new highs. Why should I worry?" And yes, that is historically true. The market has always recovered. But here is what people miss. Recovery can take a very long time. After the 1929 crash, it took 25 years for the market to get back to its previous high in nominal terms. 25 years if you were 70 in 1929, you were 95 before the market recovered. That is not a useful time horizon for retirement planning. After the 2000 dot-com crash, the Nasdaq took 15 years to get back to its previous high, 15 years of waiting. And if you needed to spend money during that time, if you needed to draw from your portfolio to live on, you would have locked in losses and never fully participated in the eventual recovery. This is the reality that older investors face. Yes, markets eventually recover. But you might not have enough time to wait for that recovery. And if you need your money to live on during the downturn, you cannot wait anyway. You are forced to sell at reduced prices, permanently impairing your wealth. The only solution is to position yourself so that you never have to sell during a downturn. Have enough cash and safe assets to live on for years. Keep your equity exposure modest enough that even a major crash does not devastate your total portfolio. Own defensive assets that hold up better during crises. Have some gold for true catastrophic scenarios. That is wealth preservation, not maximizing returns, not beating the market, just making sure that no matter what happens, you are going to be okay. You are going to have enough, you are going to preserve what you have built over a lifetime. I want to leave you with something I learned many years ago. The first rule of investing is never lose money. The second rule is never forget the first rule. When you are young, you can afford to be aggressive. You can afford to take risks. You have time to recover from mistakes. But when you are over 70, every dollar matters. Every loss is harder to recover from. Every mistake has lasting consequences. Be conservative, be patient, be prepared. The next few years could bring significant market turbulence. Position yourself to survive and thrive no matter what comes. Your future self will thank you for the peace of mind that comes from knowing you are truly protected. Focus on what you can control. You cannot control what the market does. You cannot control inflation or interest rates or geopolitical events, but you can control your asset allocation. You can control how much cash you keep as a buffer. You can control whether you own defensive stocks or speculative ones. You can control whether you panic during downturns or stay calm because you know you are prepared. Make the choices today that will protect you tomorrow. Build your cash buffer. Own defensive assets. Keep your duration short. Have some gold for insurance. And then stop worrying about what the market might do. You will be ready for whatever comes. That is my ultimate wealth preservation strategy for investors over 70. It is not exciting. It will not make you rich. But it will help you sleep at night. It will help you preserve what you have built. And ultimately, that is what matters most at this stage of life. Protecting yourself and the people you love from whatever the future might bring. The peace of mind that comes from true wealth preservation is worth more than any return you might chase by taking on unnecessary risk. Remember that. And invest accordingly.